viewers, this is the third and the last video on the investor's dilemma, Jaye to Kahan Jae, investment story, building in debt and equity. In this video, I will discuss about credit risk space, and many will be surprised that I'm speaking about credit risk space in the current context. And let me explain to you why I'm saying and what I'm saying. Most investors have become extremely risk averse, and they have gone to the other extreme in terms of investing their money in money market instruments, which is only earning them 2 to 3%, and ignoring the current opportunity which is available both on, as I said, debt space as well as on the equity space. But let's talk about the debt space now. Last 2 years have been extremely bad as far as credit risk space is concerned, as all of us are aware. There have been delays, defaults and downgrades, and I do not agree with the investors to stay away from credit risk space, because they have burned their fingers in some of these credit risk space schemes also. This year also there will be some credit issues going forward in 2020. I'm not disputing that at all, but in spite of that, some of the AMCs have managed to avoid investments in such papers through their process and discipline. You know, two of the AMCs which come to my mind is ICICI Prudential and IDFC. ICICI Prudential has recently got an award also for managing credit risk space the best. On top of that, I think their AMC has invested almost 400 crores of their own money in their own credit risk scheme, and that gives us a lot of comfort to say that if they have invested their own money, I'm sure investors should also look at that on a positive side. Currently, the yields on this credit space, risk space, is almost 9.5 to 10%. And let's assume that there are some defaults or delays in this year itself. Even if you have to take a shave off of maybe 2 to 3% because of these defaults or delays, the 9% or a 10% YTM is big enough for us to take that as a blow and have some cushion on the yield side. So worst case scenario is what you will earn will be what you would be earning in the corporate bond space, AAA corporate bond space of 6.5–7%. But having said that, identify such AMCs and invest in their credit risk schemes only who understand this credit space better and who has managed to do well in this past 2 years of bad credit space altogether. Do not go and start chasing YTMs once again and make the same mistake. To err is human, but to repeat the same mistake is actually sacrilege. So these will be investing into 1 to 3 year corporate bonds. Credit risk space also will be doing the same thing. So 1 to 3 year short term schemes, corporate bond space or credit risk space, depending on which investment avenues you would like to invest in, is the opportunity which is knocking on our doors currently. As I've explained to you in the first video, the compression has not happened on the corporate bond paper so far in the 3 year to 5 year segment. On top of that, the spreads have widened from 135 or 150 to almost 200 basis points because of the more than expected repo rate cut and less than expected yield compression so far. So this is an investment opportunity which I have been speaking about on the debt side. Nothing is going to happen on the economic front for the next foreseeable future, and all that, remember, is extremely good as far as debt markets are concerned and investments in debt space is concerned. So please understand process and risks when you are investing in at least the credit risk space side, and please understand that AAA also is a credit, AA is also credit. So anything which is corporate bond funds, whether it's a AAA or a AA, there is a credit involved as far as they are concerned. As far as the investors are concerned. So please understand the process. So what are the asset side concentration which you should be looking out for and avoiding is what I'm going to discuss. SEBI has guidelines to say that individual security, the mutual fund scheme cannot invest more than say 10% in one individual security. Do these mutual fund schemes have internal checks and balances and saying I will not invest more than 2% or 3% or 5% in any individual security? That's the internal checks and balances which we need to ask questions of the relationship managers or the fund manager. SEBI allows, I think, 15 to 20% in group exposure of say a Tata group or a Birla group or XYZ groups, But do the schemes have their own internal checks and balances in saying that I will not go more than 4%, 5% in any particular group to avoid that asset side concentration? So these are important questions you need to understand, ask, before which you should not be investing in the credit risk space. On the liability side concentration, individual investors can invest as per SEBI guidelines. There is a rule of 20-25. That means not less than 20 investors in one scheme and not more than 25% of that scheme corpus should be invested by one individual investor. That's a humongous on the outer side in terms of the limits which SEBI has allowed. So does the mutual fund have internal checks and balances saying I will not take more than 5 crores, 50 crores per folio, per investor based on the corpus of that scheme, is what we need to understand and ask. On top of that, there are some, this is one risk which not many people are aware of also, and they don't even ask because they are not aware of this risk whatsoever. This is the per distributor exposure risk. Many banking channels or national distribution channels sell some debt schemes very aggressively. So that means, let's assume there is a 1,000 crore scheme and 70% of that may have been contributed by one particular channel partner, which can be a bank, national distributor, or a big IFA also. That creates a lot of risk as far as concentration is concerned. When that particular channel partner gives a disinvestment or a redemption call, then there will be a huge liquidity risk as far as that scheme is concerned. So these are the processes and risks which you and I need to ask the fund manager and the mutual fund houses before we take investment call into credit risk side also. But these are the opportunities. If we miss these opportunities, is what I would not recommend you to do. Drastic rate cuts in small savings schemes, as all of us are aware that government of Ministry of Finance has actually announced huge rate cuts in small savings schemes like recurring deposit, NSCs, PPF by almost 100 to 150 basis points. How will pensioners who are depending on these small savings schemes and their income, how will they survive? That's when they need to complement their investments through mutual fund debt schemes. It can be corporate bond, AAA corporate bond, which will still be better in terms of both yield wise also, at the same time on the taxation benefit also, which has, as all of us are aware that mutual fund schemes have a long-term capital gains tax after 3 years with indexation benefit. So there are big differences as far as your normal small savings schemes versus investment in debt schemes are concerned. And finally, I would only recommend that once you invest in either corporate bond scheme, short-term plan, or even credit risk schemes, please think of debt as a long-term investment. There is a huge reinvestment risk which most of the investors are not aware of. In last 22 years, bank fixed deposit rates have fallen by almost 50%. So every time when there is an exit load which gets over, or 3 years gets over for long-term gains tax benefit to kick in, investors try to churn that portfolio by exiting from that and getting into something else. That's really not the right way of looking at it. Invest in one of these schemes at the right time, which is the current time. Hold it for longer periods of time, for 5 years, 10 years. Treat that as a passive debt investment from your side under your asset allocation strategy, and only do in and out of equity based on the equity valuations, and that should take care of your requirements both on the debt side as well as on the equity side. I hope you've understood the opportunities available on the debt space. I have spoken, as I said, enough on the equity side on my social media platforms and through webinars also. But please do not miss out on this opportunity in spite of RBI having cut rates. Many think that since RBI have cut rates, there is no opportunity left in the debt space. Think again. This is actually an investor's dilemma which is on the pleasant side. Jaye to kahan jaye. Thank you so much. Mutual fund investments are subject to market risks. Read all scheme related documents carefully.